just probability. You know, the analogy we always use is horse racing. In a horse race, every horse is a probability. It's shown in the odds. So whatever the bookmaker has the odds at, that's the probability that the horse, according to the bookmaker who has an opinion about these horses, has a lot of inside knowledge about horses, according to their educated, informed opinion, that's what the odds are, plus their margin, which is about 10, 15, 20%, depending upon the liquidity of the event. So they add an over round, what's called an over round, onto the horse itself. So they'll add an over round of between 10 and 20%. And that's like the house margin or the bid offer spread. So if it's a 2-to-1 horse in the bookmakers, it's not actually a 2-to-1 horse in the bookmakers. It's actually 2.2, for example. So like 2.2 to 1. So that gives the idea that they're giving you 2-to-1 on a 2.2 horse. So that's why you can never win against the bookmakers unless you have an edge against them. So probability says that horse still has a 50% or a 30% or a 10% chance of winning, but that's not going to win you money. What you've got to try and do is beat the odds, haven't you? What you've got to do is beat the odds. And it doesn't matter if you beat the odds on a 10-to-1 shot or a 100-to-1 shot or an even money shot. You've got to beat the odds. Jimmy will tell you this. Jimmy, I know, likes the horses. If you can't beat the odds, it doesn't matter what the probability is on anything. It means nothing at all. Probability is just probability. What you've got to be able to do is beat the probability, beat the odds on whatever it is you're trading. And it's the same when you're looking at the markets. You've got to beat the probabilities. You've got to be better than the fact that the line's going up or down, or the fact that this is why things like moving averages over the long run are loss leaders, because you need a certain market condition for it to work and various other things happening. But the whole point about the process that we were trying to get people to understand, the whole max process, is it's about beating the probabilities. So we can see from the spectrometer process that we have the idea of what the probability is. That doesn't tell me whether I'm beating the probabilities. It doesn't tell me anything about whether I'm beating the probabilities. What it tells me is what the probability is. Okay, so on that basis, of course, a higher price with a higher probability is going to be usually at a higher price. So when we look at a higher price and a higher probability, that's normal. That's what supply-demand economics is. As the price goes higher, there's a higher probability that it's going to become a sell. That's why the markets cycle round, but it doesn't mean I've got an edge. It means nothing about what edge I've got. It just means I've got a higher probability. Now, what we then talk about is how do we build an edge from that information? We build an edge by recognizing the lower price with a higher probability, because now we're actually inbuilding into that the concept of price action and price discovery into that edge, because it's like a horse, for example. Imagine you're seeing a horse getting backed at 10-to-1 and the bookmaker drops it from 10-to-1 to 8-to-1. And then the horse doesn't get backed at 8-to-1. So what happens? The horse doesn't get backed at 8-to-1. So what does the bookmaker do? They lift it to 9-to-1. Maybe goes back to 10-to-1 because they're not getting any money for this horse. It goes back to 10-to-1. As soon as the horse hits 10-to-1, somebody comes in and backs the horse quite heavily at 10-to-1. And the horse drops to 9-to-1 or 8-to-1. So what's happening there? Well, we've just established the real odds for that horse. Somebody thinks that the real odds for that horse are going to be approximately, say, 9-to-1. Why they're not backing at 9-to-1, because 9-to-1 is fair value, 8-to-1 is a bad bet, right? But 10-to-1 is a good price against a 9-to-1 horse, isn't it? You've got a 10% edge. If you can find 10% edges on every horse you ever back, you will be a very, very, very wealthy gambler, if you like. But you're not trading gambles. You're trading probabilities and edges. So when you see a horse getting consistently backed at a certain price, but not backed anywhere else, you've just established the real odds. So when a horse gets backed at a lower price, you've now established that those odds are now something of interest, right? Take a look at this little live screen here. This is a race that's coming up in, what, 5:35 at Pontefract. I don't know why that's particularly relevant. It's not. But you can see here, if you look at the odds on this screen, look at the odds here. So these are the horses from the favourite onwards, right? You can see that this horse drifts from 4.0 to 4.3 and then back to 4 and then 4.3 and then back to 4. In other words, this horse is getting backed at 4.3 every time it trades there. So the odds on this horse being good value at 4.3 is pretty high. So that's quite a good high probability bet at 4.33. However, at 4.0, it's not a good bet. So you might see that taking place and then back it at 4.0. But you're just backing a horse now at fair value, aren't you? If you back the horse below 4.0, you're a mug punter. You're an absolute mug punter, aren't you? Because you've got no evidence at all that there is any reason to back below 4.0. So if you back at 3.5 or 3.75 or whatever, you're a mug punter. But if it drops to 3.5 or 3.75, you're going to try and back at 4, aren't you? Because 4 now looks as if it's actually getting enough value. Does that make sense? So you can see all of these horses. You can see that when the horse drifted out to 8.5, somebody felt that that was genuine value to back this horse, Emperor Caradoc. So if somebody thought it was value, then fair value must be the lower price, 8.0. But then the bookies have dropped it to 7.5. So the person that backed it at 8.5 must have decided that 8.0 was still representing good value, or possibly that they're not going to get any more money on at 8.5 because the bookmakers keep pulling off the price level. And for that reason, the price is then dropped to 7.5. And what might happen next is, if it's still really good values, the price will go from 7.5 to 7.0, in which case we know 7.5 is good value. So when we see these good value trades, the worst thing that can happen now is I back it at 7.5. Does that make sense? Because I don't know if I'm actually backing value. Do you understand that? I've no way of knowing if I'm backing value or whether I'm just getting fair value. If I back horses at fair value, I'm not going to be a winning bettor on this race. So when I see a horse that's been well supported, so you see this horse traded down from 15s to 12s to 11s back up to 12s. 12 looks like it's still a relatively good price for this horse at 12s, but 11 doesn't. So somebody would look at that sequence and say, oh, I'm backing at 11. I would never back this horse at 11. But I might consider backing the horse at 12 because I've already seen that backer coming in at 12. So this is what we start seeing in the spectrometer process, isn't it, when you think about it? We see somebody that's backed a particular edge, and now we've got a higher probability of that edge becoming a thing, haven't we? We've got a higher probability of that edge being real. How do we know? Well, because we can see the probability at the same price. So if the probability rises at the same price, that must be a genuine edge. There must be a real opportunity to maybe take a shot at this. Well, delta allows us to do the same thing. Book liquidity allows us to do the same thing. So it allows us to start looking at the real edges that we can get from simple things like volumes and market structures and key decision levels. We showed you a screenshot from this morning about the dealer's keys. And the blue line is a real edge. It's a real quantifiable edge. It's real. So if this blue line is real, then the signals that are generated from it from these key levels are also real. So when I see this key level rejecting on the buy side, and then I see the buyer at higher prices here, I'm all in. I'm not going to lose money on that. I'm all in. Give me as much as I can grab on this bit of business. Make sense? I am all in. So when you see that trade, you say, wait a second, that's actually bloody good. It's a very, very nice, easy money profit there, isn't it? And then we see another exact same situation there, all in. Look at the drawdown in these trades, guys. How much drawdown? 1 or 2 ticks. And there you go. There's over $1,000 profit. And there was the last trade we had here at 54.52, guys. It's just traded 54.92. You might say, yeah, but you're not showing us any other trades. There could have been a sell trade or a buy trade or a whatever trade in that top edge location. So how do we know that that would have been the reality of that trade move? Well, because we can obviously take a screenshot of what we've currently seen from that particular trade, and you can see for yourself how it would have played out. So that's exactly what we'll do. I'll take a screenshot. And remember, the trade level should have traded. It should have already traded. So let's take a look at that buy trade that we've just talked about there. So there's the buy trade off of a dealer's key. Remember, this is the one that came up one tick shy of a dealer's key. And the trade ripped away beautifully. And then we got up to the next dealer's key at 75. And you can see it looks like they're going to buy it. It looks on the face of it as if they're going to buy this dealer's key here. Now, that's not the trigger because we've got to see them buying the dealer's key. So then they buy the dealer's key here. But look at what happens here twice. Do you see it? Twice. See the buy trades there and there? Exactly the same as what happened here at exactly the same point in the charts, roughly. Well, you can't be roughly exactly the same, can you? Well, you get the basic idea. And what happened next? Well, you can see we got all the way up to the top edge here. And you can see they still seem to be keen on this, but that's not the trade. That's not a trade because that hasn't traded off that level. It's got to be above the level. It's got to be above the level for that to be a buy trade. If it's not above the level, it could just be a bit of manipulation trying to get the price to pop that level, right? If it's below the level, when obviously if we traded the level, it would be perfect because then we could take a shot at the sell trade at that point. But if it's not below the level, then we've still got some challenges to make sense of this bit of business here, right? So we've still got some opportunities, some challenges on this as a narrative. And again, that's okay because that's what we're here to try and do is find these opportunities to play this, right? We're trying to find these opportunities at these key levels. And that trades just went from 52 to a high price of 92 here. 52 to 92. And if we've just went 52s to 92s, guys, that's a $2,000 dealer's key, dealer's book trade sequence there. $2,000 per contract. And that's on the back of $1,000 from that earlier trade that we showed you a while ago. $1,000 from the earlier trade. Anyway, we're 5 minutes ahead of the cash open. Ready to rock and roll, guys. Ready to rock and roll. 5 minutes ahead of cash open.